Well, hello there, NASDUCK listeners. Rick Sullivan here, and if you caught my last episode about payment for order flow, you know we peeled back the curtain on how this whole commission-free trading game really works. Today, we're getting practical. We're going to dig into the actual platforms you're using or thinking about using, and I'm going to tell you which ones are actually worth your time and which ones are basically digital pickpockets in fancy clothing. You know, after spending the last few weeks really diving deep into these platforms, not just reading their marketing materials, but looking at user complaints, regulatory filings, fee schedules, and talking to people who've actually used them, I've got some strong opinions. And some of them might surprise you. Some time ago, my neighbor Tom told me he'd just set up his first brokerage account. Tom's a mechanic, good with his hands, makes decent money, but knows nothing about investing. He downloaded Robinhood because, hey, it's free, right? Simple interface, no minimums, seemed perfect for a beginner. 3 months later, Tom calls me up, frustrated as hell. He'd been trying to get customer support to help him with a tax form issue for 6 weeks. 6 weeks. When he finally got through to someone, they couldn't answer his question and transferred him to someone else who also couldn't help. Meanwhile, he's got the IRS breathing down his neck because Robinhood's tax reporting was completely screwed up. That's when it hit me. We spend more time researching which TV to buy than which broker to trust with our life savings, and that's exactly what these platforms are counting on. So let's fix that today. I'm going to walk you through the real differences between these platforms, and I'm going to tell you which ones I'd trust with my own money and which ones I wouldn't touch with a 10-foot pole. Let's start with the 800-pound gorilla in the room, Robinhood. Look, I've got to give them credit for one thing. They forced the entire industry to drop commissions. Before Robinhood came along, you were paying $7 to $10 a trade at most places. That was real money that added up fast for small investors. So in that sense, they did something good. But here's the problem. Everything else about Robinhood is designed to extract money from you in ways you can't see. First, the reliability issues are insane. 21 outages in March 2020 alone. Let me put that in perspective for you. March 2020 was when the market was having some of its wildest swings in history. People needed to trade, needed to get out of positions, needed to rebalance their portfolios, and Robinhood was down more often than it was up. I talked to a guy who lost 40 grand because he couldn't sell his airline stocks when they were tanking. $40,000. That's more than most people make in a year, gone because his broker couldn't keep their servers running. But the outages are just the tip of the iceberg. The real problem is the execution quality. Remember Mike from my last episode? The plumber who paid an extra $40 on his Apple trade? That's not unusual with Robinhood. Their execution quality is consistently among the worst in the industry. Here's a number that'll blow your mind. Only 25% of Robinhood orders get filled at the mid-price or better. Compare that to TD Ameritrade at 75%. Same stocks, same market conditions, completely different results. Accident? Nope. That's a business model if I've ever seen one. And don't get me started on their customer service. It's essentially non-existent. Email only for the most part. Good luck getting help when you actually need it. The thing that really bugs me about Robinhood is the psychological manipulation. The confetti animations when you make a trade, the way they make options trading seem like a game, the constant push notifications trying to get you to trade more. They've hired teams of behavioral psychologists to figure out how to get you to trade more frequently, because every trade makes them money through payment for order flow. It's what I'd like to call addiction engineering. Now, having said all that, I understand why people use Robinhood. It's simple, it's accessible, and if you're just getting started with small amounts of money, the execution quality issues might not matter much. But here's my take. If you're serious about building wealth, you'll outgrow Robinhood pretty quickly. And when you do, you'll realize you've been paying a hidden tax this whole time. Let's talk about Webull, because a lot of people see it as the smart person's Robinhood. Webull does have better charting tools and more advanced features than Robinhood. If you want to look at technical indicators or do some basic analysis, Webull gives you more to work with. They also have better extended hours trading, and their mobile app is pretty solid. But here's the catch, and this is something most people don't realize. Webull's commission-free trading is only free for the first month. After that, they charge $0.0025 per share for stocks and 50 cents per options contract. Now that's still cheap, but it's not free, and they don't exactly advertise this prominently. More importantly, Webull is a Chinese-owned company. Now I'm not paranoid about China, but I am paranoid about data security and regulatory oversight. 14 state attorneys general have raised concerns about Webull's ties to the Chinese Communist Party. Tennessee banned it on government devices. Maybe that matters to you, maybe it doesn't. But it's something to be aware of. The bigger issue with Webull is that they're trying to be everything to everyone, and they're not particularly good at any of it. Their educational content is terrible despite targeting beginners. Their research tools are decent but not great. Their customer service is hit or miss. So it's a Swiss Army knife when what you really need is a screwdriver. Sure, it's got a screwdriver attachment, but it's not as good as a real screwdriver. Let me tell you about some platforms that actually try to serve their customers instead of mining them for data and fees. Fidelity is probably the best all-around choice for most people. They've been around since 1946, which means they've survived multiple market crashes, technology changes, and regulatory shifts. There's something to be said for that kind of institutional knowledge, but more importantly, their incentives are aligned with yours. They explicitly refuse payment for order flow for stocks and ETFs. That means when you place a trade, they're trying to get you the best possible price, not route your order to whoever pays them the most. The numbers prove it. Fidelity reports average savings of $24.50 per 1,000 share order compared to industry averages. That might not sound like much, but it adds up fast. If you're making regular investments, say $2,000 a month into index funds, that execution quality difference could save you hundreds of dollars a year. Fidelity's customer service is actually good. Like, you can call them and talk to a human being who knows what they're talking about. Revolutionary concept, I know. During the GameStop chaos in 2021, when people were fleeing Robinhood in droves, Fidelity got over 7,000 positive reviews from people who'd switched over. That tells you something. They've also got great research tools, educational content, and they offer fractional shares. You can invest in any stock with as little as $1. And unlike some platforms, this isn't some gimmicky feature, it's built into their core platform. The downsides, their mobile app isn't as flashy as some of the newer platforms. If you're used to Robinhood simplicity, Fidelity might feel a bit overwhelming at first, but that's because they're giving you actual tools instead of a toy. Also, they don't offer direct cryptocurrency trading. You can buy Bitcoin and Ethereum ETFs, but if you want to trade crypto directly, you'll need another platform. But for 95% of investors, Fidelity is probably the right choice. They're transparent, reliable, and their interests align with yours. Charles Schwab is another solid option, especially after they acquired TD Ameritrade and integrated the Thinkorswim platform. Schwab's big advantage is that they offer institutional quality tools with retail accessibility. The Thinkorswim platform is probably the best trading platform ever built. It's got 374 technical indicators, advanced options analysis, paper trading for practice, and customization options that can make it work for any trading style. They've also got great research, access to IPOs, and solid customer service. Plus, they're a bank, so you can do your checking and savings there too if you want everything in one place. The downside is that Schwab does accept payment for order flow. Their rates are lower than some competitors, about $0.001 per share for stocks, which is relatively modest. But it's still a conflict of interest. More importantly, the integration with TD Ameritrade has been rocky. A lot of former TD Ameritrade customers are complaining about the new Schwab interface being clunky and less intuitive than what they're used to. Change is hard, but when you're dealing with people's money, it needs to be seamless. I've also heard complaints about Schwab's margin rates being on the high side and their interest rates on cash being low. Not deal breakers, but things to be aware of. Overall, Schwab is a good choice if you want professional-grade tools and you're okay with the payment for order flow trade-offs. They're particularly good for active traders who can take advantage of the Thinkorswim platform. Now let me tell you about Interactive Brokers, the platform that serious traders and institutions use. They've got access to 160 markets in 34 countries, margin rates around 5% compared to 11% elsewhere, and execution quality that's absolutely top-notch. They give you a choice. With IBKR Lite, you get commission-free trading, but they use payment for order flow just like everyone else. With IBKR Pro, you pay small commissions, usually $1 or less per trade, but they route your orders for the best possible execution without selling your flow. For active traders, this is a no-brainer. The improved execution quality more than makes up for the small commissions. I know day traders who save thousands of dollars a year by using IBKR Pro instead of free platforms. The international access is unmatched. If you want to buy stocks on the London Stock Exchange, or Japanese companies, or emerging market bonds, Interactive Brokers can do it. And their currency conversion fees are basically nothing, about 0.002% compared to 0.5 to 1% elsewhere. Here's a real example. If you want to buy $50,000 worth of European stocks, most platforms will charge you $250 to $500 just for currency conversion. Interactive Brokers charges about $10. That's not a small difference. The downsides are real, though. Their platform looks like it was designed in 1995. It's incredibly powerful, but it's also incredibly complicated. If you're not comfortable with technology, or if you just want to buy some index funds and forget about them, Interactive Brokers is probably overkill. Their customer service is also hit or miss. They're great if you know exactly what you're asking for, but if you need handholding, you might be frustrated. But for sophisticated investors, especially those who trade internationally or use margin, Interactive Brokers is probably the best choice available. So, how about some of the newer platforms that are trying to do things differently? Public.com made a big splash by eliminating payment for order flow in 2021. They said they weren't going to sell their customers orders anymore, and instead, they'd make money through subscription fees and optional tips. I respect that. It's a more honest business model. You know exactly what you're paying and why. There are no hidden revenue streams that might conflict with your interests. Public also has some interesting features like social investing, where you can see what other investors are doing and even copy their trades if you want. They've also added alternative investments like art and collectibles. The downside is that they're still pretty limited. No options trading, no margin, no international stocks. If you want to do anything beyond basic stock and ETF investing, you'll need another platform. But for beginners who want a simple, transparent platform without the psychological manipulation of other apps, Public is worth considering. Moomoo is another interesting one. They're expanding internationally pretty aggressively, and they offer some unique features like access to IPOs and 24-hour trading for certain stocks. Their fee structure is a bit weird though. They don't directly accept payment for order flow, but their clearing broker does, so you're still subject to the same conflicts of interest. It's like payment for order flow by proxy. They also have some concerning user reviews about slow deposit and withdrawal times. When you need access to your money, you need access to your money. Delays aren't acceptable. E-Trade used to be a major player, but honestly, I think they've been left behind. They're owned by Morgan Stanley now, which gives them access to good research, but their platform feels dated and they don't offer international trading at all. They also have a bunch of hidden fees that can add up. $6.95 for over-the-counter stocks, $38 for certain corporate actions, fees for real-time market data unless you maintain a $10,000 balance. These aren't huge individually, but they violate the principle of transparency that I think is so important. For most people, there are better options available. One thing I really need you to focus on is customer service and reliability. Most broker comparisons completely ignore those. This stuff matters way more than people realize. When the market is crashing and you need to adjust your positions, or when there's a problem with your account, you need a broker that actually works and can actually help you. I've seen too many people lose serious money because their broker's app crashed during a volatile day, or because customer service couldn't resolve a simple issue for weeks. Fidelity consistently ranks at the top for customer service. You can call them, get through to a human being quickly, and that human being can actually solve your problem. Wild concept, I know. Interactive Brokers is hit or miss on customer service, but their platform reliability is excellent. They've got institutional grade infrastructure that's designed to handle massive volume and volatility. Schwab is generally reliable, though the TD Ameritrade integration has caused some hiccups. Robinhood and most of the newer platforms, forget about it. When things go wrong, you're basically on your own. We're talking risk management. If you can't access your account when you need to, that's a form of risk that could cost you serious money. With international trading, platform choice really matters. That's where most people get completely screwed on fees. If you only want to invest in US stocks and ETFs, most platforms will work fine. But if you want true global diversification, actually buying stocks on foreign exchanges, not just ADRs, your options get limited fast. Interactive Brokers is by far the best option. They give you access to 160 markets in 34 countries, they settle trades in local currencies, and their currency conversion fees are essentially zero. You can buy stocks in Tokyo, bonds in Germany, and REITs in Australia, all from the same account. Fidelity offers some international access, though not as comprehensive as Interactive Brokers. Schwab offers trading in about 30 global markets. But it gets expensive fast if you're not careful. Most platforms charge 0.5 to 1% for currency conversion. That might not sound like much, but on a $100,000 international investment, that's $500 to $1,000 just to convert your dollars to euros or yuan. Interactive Brokers charges about 0.002%. On that same $100,000 investment, you'd pay about $20 for currency conversion. That's not a small difference, that's enormous, and it gets worse. Some platforms like eToro operate entirely in USD, which means if you're not in the US, you're paying currency conversion fees on both ends, when you deposit money and when you withdraw it. Plus they charge $5 for every withdrawal. I calculated that a European investor using eToro could easily pay 1% to 2% in various fees and conversions just to get money in and out of the account. That's before you even consider the quality of execution. If you're serious about international investing, you really need to pay attention to these fees. They can easily dwarf any savings you might get from commission-free trading. Something that I think is really important but doesn't get talked about much is the hidden costs of platform switching. Most brokers charge you to transfer your account out. It's called an ACAT fee, and it's usually $50 to $75. Some charge even more for partial transfers. This might seem small, but it's actually a form of lock-in. Once you've got a substantial account somewhere, that transfer fee becomes a psychological barrier to switching, even if another platform would serve you better. Fidelity and Interactive Brokers don't charge outbound transfer fees. In fact, they'll often pay the incoming transfer fee if you're moving to them. That tells you something about their confidence in their service. Platforms that charge you to leave are basically admitting that they're not good enough to keep you voluntarily. Now that we know all that, let me give you my take on which platforms make sense for different types of investors. If you're just getting started, have less than $10,000 to invest, and want to keep things simple, I'd probably recommend Fidelity. You get excellent execution quality, good customer service, access to fractional shares, and educational resources to help you learn. Plus, as your account grows and you get more sophisticated, Fidelity can grow with you. If you're a beginner but you really want the simplest possible interface, Public.com might be worth considering. Just understand that you're giving up features and investment options for that simplicity. If you're an active trader or you have a larger account, Interactive Brokers Pro is probably your best bet. Yes, there's a learning curve, but the execution quality and low margin rates can save you thousands of dollars a year. The professional tools are worth the complexity. If you want professional grade tools but prefer a more user-friendly interface, Schwab with Thinkorswim is a good middle ground. Just be aware of the payment for order flow issues. If you're investing internationally or you want the absolute lowest costs, Interactive Brokers is really the only game in town. Nothing else comes close for global market access and currency conversion rates. If you're a casual investor who just wants to dollar cost average into index funds and not think about it much, Honestly, most of the major platforms will work fine. Fidelity is probably your best bet for the execution quality and customer service. But Schwab would work too. What about the platforms I'd avoid? First up's Robinhood, unless you're just playing around with small amounts of money and you understand that you're paying hidden costs for the convenience. The reliability issues and poor execution quality make it unsuitable for serious investing. Next is Webull, unless you specifically need their charting tools and you're comfortable with the Chinese ownership and the fees that kick in after the first month. I'd also avoid E-Trade, unless you're already there and happy with them. Their fees are higher than competitors and they don't offer international trading. Stay away from any platform that charges monthly fees for basic features. There are too many good free alternatives to pay monthly subscriptions for standard brokerage services. Be skeptical of any platform that has a history of frequent outages or poor customer service. Your broker is infrastructure. It needs to work when you need it to work. What really bugs me is the way most financial media covers this stuff. You'll read articles comparing brokers based on whether they charge commissions or not. 0 versus 0 versus 0. It's completely useless information. The things that actually matter, execution quality, reliability, customer service, hidden fees, international access, these get ignored because they're harder to put in a simple comparison chart. It's like comparing cars based only on whether they have cup holders and ignoring the engine, safety ratings, and reliability. The marketing-friendly features get all the attention while the stuff that actually affects your life gets ignored. This is intentional. The industry wants you to focus on the wrong things. They want you to choose based on headline features and ignore total cost of ownership. Don't fall for it. Here's what I do when I'm evaluating a platform. First, I look at their regulatory history. Have they been fined by the SEC or FINRA? What for? Regulatory actions tell you about a company's culture and priorities. I look at user complaints. Not just the number of complaints, but the types of complaints. Are people complaining about fees they didn't know about? Platform outages? Inability to access their money? These are red flags. Next, I read the actual fee schedule, not the marketing materials. What do they charge for wire transfers, currency conversion, account transfers, real-time market data? These fees add up. I also test their customer service. I call them with a technical question and see how long it takes to get through and whether the person who answers can actually help. And don't forget to look at their execution quality disclosures. These are public documents that show how well they're actually executing trades compared to the market benchmark. This might sound like a lot of work, but you're trusting these people with your life savings. It's worth spending a few hours to make sure you're making the right choice. I know a guy who's a small business owner, makes good money, and had about $300,000 in his Robinhood account. Yeah, I know I told him it was a bad idea, but he liked the simple interface. In February, he needed to sell some stocks to make a down payment on a new house. He placed the sell order on a Tuesday morning, and Robinhood told him the money would be available for withdrawal on Thursday. Thursday comes, he tries to initiate the withdrawal, and gets an error message. He calls customer service, gets bounced around for 3 hours, and finally gets told there's a review on his account, and it might take a few more days. A few more days turns into 2 weeks. Meanwhile, his house deal is falling apart because he can't get access to his own money. He's calling Robinhood every day, getting different answers from different people, none of whom seem to know what's going on. Finally, after 2.5 weeks and threats to file complaints with regulators, Robinhood releases his money. No explanation, no apology, just, the review is complete. This guy lost his house deal. He had to pay penalties for backing out of the contract. All because his broker decided to hold his money hostage for reasons they never explained. Do you think this would have happened at Fidelity or Schwab? No way. When you call them, you talk to people who are empowered to solve problems. They have procedures, escalation paths, supervisors who can make decisions. When you call Robinhood, you talk to someone reading from a script who has no authority to do anything. This is what I mean when I say that customer service isn't just about convenience. A broker that can't or won't help you when you need it is a form of risk that could cost you serious money. Let me talk about one more thing that I think is really important. Tax reporting. Most people don't think about this until tax time, And then they realize their broker's tax documents are a mess and they can't figure out their cost basis or capital gains. Fidelity and Schwab generally do a good job with tax reporting. Their 1099s are accurate and detailed, and they provide tools to help you understand your tax situation. Robinhood? Not so much. I've heard from multiple people who got incorrect 1099s from Robinhood and had to spend hundreds of dollars on tax professionals to sort it out. Some people got audited because Robinhood's reporting didn't match what they filed. Interactive Brokers is accurate but complex. They provide all the information you need, but you might need professional help to understand it, especially if you're trading internationally. The newer platforms are hit or miss. Some are good, some are terrible, and it's hard to know until tax time. This stuff matters. If your broker screws up your tax reporting, you're the one who has to deal with the IRS. You're the one who pays penalties and interest if there are problems. Choose a broker that takes this seriously. Whatever you choose, read the fee schedule carefully, test the customer service, and don't assume that free is actually free. Most importantly, remember that your broker is infrastructure. It needs to be reliable, transparent, and aligned with your interests. Everything else is just marketing. The financial industry has spent decades training people to focus on the wrong things. Don't let them. Your financial future is too important to leave to people whose incentives don't align with yours. That's what I've got for you today, folks. Choose wisely and read the fine print. Until next time, this is Rick Sullivan reminding you that in this business, you get what you pay for. Make sure you know what you're actually paying. Take care.